Alright guys, just give me a second here to set up the camera and we are going live. Alright guys, so today, those of you who don't know me, I'm Dave Santarelli. I'm the CEO of the Santarelli Trading Exchange. I just got this new office space, and today I'm going to be going over debit call spreads, also known as vertical spreads. I have the Santarelli Trading Exchange website, and a lot of members are asking about spreads, how they're traded, and basically when to go with a call versus going with a spread. So in this class, it's going to be basic spreads to get those who are new to spreads to fully understand through example. I'm going to be going through a few presentations that I've created. First, I'm going to start off with what is a call option. I have a little poster board that I made for that, but let me get through this first, and then at the end we're going to be doing a live questions and answers segment along with anything else that you guys like to go over. So first, let me draw my attention over here. And like I said guys, this is my first time doing this in my new office. I have some new setups that are coming, so once we get those, everything will be set. I just ordered a whiteboard, so that's going to be great once we do that. So let's get started here. First, I want to go over this, and then I have a better presentation that's set up here. But first, I want to go over the basics for those who don't know. Basically, what is a call option? Okay, a call option is the right to buy a stock at a certain price, known as the strike price, at a certain date, known as the expiration date, for a certain price, for the premium price. It can be bought and sold at any time. You don't have to hold on to it. Then let's go over a debit call spread. Alright, so buying a call, that's just buying a stock at a certain price for a set date. Alright, so for that you're paying a premium, a certain price. And we're going to go over all this. This is just like a pre-warm up here before we get into our regular presentation. So what is a debit call spread or a vertical spread? Simply put, this is when you buy a call option and sell someone the right to buy your calls from you at a higher price. That's known as the strike price. Then you paid for yours. For example, you buy the Facebook 170 call, and then you sell someone the right to buy your 170 calls for $172.50. They pay you a premium for this right. You sell the Facebook 172.50 call. Let me go over the presentation first, I think, here. Let me go through this example, though, first. Like I said, I have a good poster board set up. This is just a pre-setup here. Alright, so example 1. You're buying a regular call. You buy the Facebook 170 strike call for the October 20th expiration, and you pay $3.80. And remember, you have to multiply that by 100, since there's 100 shares in a contract. So if you only buy this call, you need Facebook at your strike, which is 170, plus what you paid for it to break even. So 173.80 at expiration, which is October 20th in this example, is your break-even point. And above 173.80, you start making a profit. And then there's deltas and thetas we could get into in our next segment, in our next class. But for a 100% gain, you need Facebook at 177.60. For a 200% gain with just the regular calls, you need Facebook at 181.40 by expiration. And again, you could sell this at any time before your expiration date. Now, example number 2 is the first example we went with buying a call. Now we're going over the example of a call spread. For example, you buy the Facebook 170 and you sell the 172.50 call spread for October 20th expiration, and you pay $1.20 per contract. You bought the Facebook 170 call for $3.80. You sell someone the Facebook 172.50 call for $2.60. The most you can make is the difference between the call you bought and the call you sold minus what you paid, $1.20. You paid $1.20 for the 170, 172.50 spread, and most it can be worth is $2.50. So $2.50 minus $1.20, that equals $1.30 max net gain. So $130 max net gain per contract. That's a 108.33% max net gain. Now let me get rid of this. I don't like this. It looks like crap. So let me go to my main presentation here. And like I said, I ordered a whiteboard, so we should be getting that this week. Let me back this up here. Let me see. Let me zoom this out. Let's see how this looks here. All right, guys, could you see that? Let me try to zoom in a little bit. All right, guys, so basically, in this example here, we have Amazon that's trading at $961.35 a share right now currently, okay? And in this example, we're going to go over the Amazon debit call spread, also known as a vertical spread. All right? I want you guys to understand spreads, because with spreads, it's so much easier to make a large percent return with a very small stock move, an increase in price, than with a regular call. And we're going to be going over the example of this. All right, so in this example, you buy the Amazon October 20th, $977.50, $980 debit call spread. And here's how it breaks down. You're buying to open, let's just say 10 contracts of the October 20th, $977.50 strike call. And these are live prices. If you guys open up your brokerage account, this is actually what Amazon is trading at right now for these strikes. All right? So you buy to open 10 contracts of the October 20th, $977.50 strike call for $10.10 a contract. 10 contracts times $10.10 equals $101. But since there's 100 shares in a contract, you have to multiply that 101 times 100. And that becomes 10 contracts for the $977.50 strike call. That cost you $10,100. So basically, and think of this, okay? And this is if you're buying, let's just say, the regular calls, okay? One contract gives you control over 100 shares. So if you're buying 10 contracts of the Amazon $977.50 strike call, you're getting control over 1,000 shares of Amazon. And think of that. If you bought 1,000 shares of Amazon right now in the open market, which Amazon's trading at $961.35 a share, those 1,000 shares are going to cost you $961,350. Think about that. 1,000 shares are going to cost you $961,350. Whereas if you bought the 977.50 strike call for October 20th Expo, you're paying only $10,100 for that right to control 1,000 shares of Amazon above the 977.50 strike. All right. So now back to the spread here. So at first you bought to open. We're going with the 10 contracts in this example. You bought to open 10 contracts, October 20th, 977.50 calls for $10.10 a contract. And then to turn it into a spread, you're selling to open 10 contracts of the October 20th 980 strike call. Now, you don't have to do 980. You could do anything higher than the 977.50. This could be the 982.50, 985. It could be the 990. It could be the 1,000 strike. Okay? But in this example, we're going with the 980 strike. So you sell to open 10 contracts of the October 20th 980 strike call at $9.30 a contract. This is going to cost you $10.10. That's what we paid for the 977.50 strike minus $9.30. Because when you sell to open the 980 strikes, you're bringing in a profit, a premium for selling someone that right. So you're paying $10.10 to buy the 977.50, but someone's paying you $9.30 per contract to buy 980 strike call from you, okay? So the cost is $10.10 minus $9.30, which equals 80 cents. And like I said, there's 100 shares in a contract, so you have to multiply that 80 cents by 100. So in this example, this spread's only going to cost you $80 per contract. So if we bought 10 contracts, this Amazon spread here is only going to cost us $800. All right? And what's our max gain? Okay? Our max gain is the difference between the two strikes. So 980 minus 977.50, that's $2.50. So 10 contracts, and like I said, again, you have to multiply that $2.50 by 100 since there's 100 shares in a contract. So the max this could be worth is $2.50. Multiplied by 100, that's $2,500 for 10 contracts. So something that you're paying $800 for can be worth $2,500 if the stock goes as planned. All right, so back to the example here. Our max gain is when Amazon is at or above $9.80 a share on expiration date. We have the October 20th Expo. Okay, so as long as Amazon's at $9.80 a share or higher on October 20th, this spread here is going to be worth max value. It's going to be worth the $2.50, $250 per contract. So if you pay $80 for one contract and Amazon is at $9.80 or higher on October 20th, your $80 that you invested is worth $250. All right, so back to the example here. Our break-even point is the strike we bought, $977.50, plus the premium paid. So $977.50 plus 80 cents is $978.30. So that's our break-even point. Our break-even is when Amazon's at $978.30 on October 20th. All right, so now let's say expiration date comes. Amazon is at $981.35 on October 20th expiration date. What happens to our spread here? All right, so then our spread is at maximum gain with Amazon at or above $9.80 a share. And since Amazon in this example is at $981.35, this spread is worth its max gain. So our gain is $2.50 minus what we paid for it. This is to figure out our net profit. So our max gain is $2.50 minus 80 cents, which is $1.70 or $170 per contract. So something that you paid $80 for, you now have a net gain of $170. that $80 for a single contract is now worth $250. So we have a profit of 212.50% gain. I mean, think about that. Amazon only had to go up from $961.35 where it's currently at. It only had to go up $18.65, and we still have about 3 weeks for that to happen. All right. I actually like this trade. I like this trade a lot. I do think this is a good trade to make now. I think there's a high probability of this trade being worth its max gain and making that 212.5% gain. But like I said, you only need Amazon to go $18.65 higher to make a 212.5% gain. And that is less than a 2% move. That's less than a 2% move in Amazon shares in 3 weeks. Amazon goes up 2% in the next 3 weeks, and this trade here would make a 212.5% gain. All right, now what I want to do, I want to go over basically a call versus a call spread, okay? I want you to see a live example of what a regular call would do versus a call spread. So for that example, we're going to do the same thing with this Amazon trade. We're going to break down this Amazon trade, but now this time we're going to look at the calls. We're going to see what would happen if we bought the calls, okay? So let me see here. All right, so basically we have the same thing here. All right. And I want you to look at this now because this is what we're going to go over for the time being. All right, so let me get a little something here besides for my laser pointer. My laser pointer's a little shaky here. So, all right, guys, so basically this is the same thing. Same thing as we were going over before. So in this example up here, we went over the Amazon debit call spread. Here we're going to go over Amazon calls. All right. So let's say you bought the October 20th 977.50 strike call. It cost you $10.10, which is $1,010 per contract. So to have control over 100 shares of Amazon, it's going to cost you $1,010. But with our spread, we have our max gain. We can't make anything above that 212.5% gain. Whereas if you buy a regular call, your maximum gain is unlimited, basically. All right? So back here now, we buy the October 20th 977.50 strike call, just like we bought in the example of the spread. It cost us $10.10, $1,010 per contract. Our break-even is the strike price, which is $977.50, plus the premium paid, which is $10.10. So our break-even is $987.60. So with Amazon at $987.60 on October 20th, this call breaks even. All right? Now, what do we need for a 100% gain? It's very simple to figure this out. All right? For 100% gain, all you need is the break-even point, and you multiply that or add it to the premium paid. So $987.60 is our break-even. For 100% gain, we just needed to go $10.10 higher. So for a 100% return on Amazon calls, we need Amazon at $997.70 for a 100% gain. For a 200% gain, we needed $10.10 higher than $997.70. So a 200% gain, we need Amazon at, I can't see it below there, but we need Amazon at $1,007.80 for a 200% gain. Okay? Now, let's go over the Amazon call spread. This is the same one we just went over. Okay? Same thing. All right, so again, this is what we went over on the big poster board here. You buy the $977.50, $980 spread. It costs you 80 cents per contract. Break even is the strike price that we bought plus the premium paid. So break even's $978.30. All right. Our max gain is the difference between the two strikes, between the $980 and $977.50. So $2.50 is the max this spread can be worth. Our net return is the difference between the strikes minus the premium paid. So $2.50 minus 80 cents is $1.70 net gain, $170 net gain per contract. And our max gain, like I said before, is 212.50%. Now let's go over a call versus a spread here. Let's see how it would have worked out. Okay. So again, in this example, we're going over the call versus the spread. Let's say Amazon's at $9.90 a share on October 20th. All right. So Amazon on October 20th is at $990 a share. All right. Our $977.50 strike calls, they are worth $9.90, where the stock's trading at, minus our strike price. So $9.90 minus $977.50. That means this call is worth $12.50. We paid $10.10. It's now worth $12.50. So $12.50 minus $10.10, that's a $2.40 or a $240 net gain per contract. And that comes out to a 23.76% net gain. So if you just bought the calls, if you just bought the $977.50 calls, and on October 20th, Amazon's at $9.90 a share, we have a net gain of 23.76% net gain. And think about that for a second, guys. You know, this is important here. You're buying a regular call, and you need the stock. With the stock at $9.90 a share, you're only making a 23.76% net gain. Whereas when we get the call spread, we bought the $977.50, $980 call spread for 80 cents. Our call spread is at max gain with the stock at $9.90. All right. So since the stock is above $9.80, we only need the stock at $9.80 or higher for us to have that max net gain of 212%. So we paid 80 cents for this spread. It's now worth $2.50. Like I said, $2.50 minus 80 cents, that's $1.70 or $170 profit per contract. That's a 212.5% net gain with the spread. So with the calls, we only made a 23.76% net gain with the stock at $9.90. All right? And like I said in this other example here, if we went back here, to this example, for 100% gain with just the regular calls, we needed Amazon to get at $997.70 for 100% gain. For a 200% gain, now remember, the call spread that we just went over made a 212.5% gain. For a 200% gain, just owning this, buying the calls, we need the stock at 1,007. We need the stock at 1,007.80 for a 200% gain. So 1,007.80 for a 200% gain, whereas the call spread, we only needed it at $9.80 per share for a 212.5% gain. So I hope you guys can see and understand why a call spread sometimes is a much better investment than going with the than going with the spread. Or going with the calls for, I should say. So, I'd like to answer any questions that you guys have. Like I said, this is my new office setup. This is the new headquarters for the Santarelli Exchange. I have a few office spaces here. So, I just ordered a whiteboard. So, we'll be having presentations on that once that comes. That should be coming this week. I also have my trading rig that I ordered. I have from Falcon Trading Computers. I have a 6-monitor array and a new desktop coming. So I have a lot of things coming, and I have a lot of stands. As you can see here, you know, that suitcase is just from me bringing up computers and stuff. But back here, you see, that is for a camera. And then I have the easel here, that's for presentations. And then I have my other computer back here, you know, as you can see. But I'd like to go over any questions that you guys have or want me to go over with you guys. Another thing I want to go over, I'm going to be doing, actually, I wanted to show you guys this too. I don't know where the sheet is, but something that I suggest every trader do, whether you're trading shares of stock or options or whatever it may be, it's very important, first of all, for you guys to have a trading plan. You know, you have to have a trading plan and a strategy that you follow and implement on a daily basis. Also, a trading journal, a logbook, and a simple logbook like this where, let me show you guys how it looks here. You know, when you guys have a logbook like this, you log your trades, all your details behind the trades, why you entered, your buy and sell signals, the quantity, your price, cost, proceeds, your net gain, and then your target, stops, return on investments, your risk, and market conditions when you made the trades, and any details you want to put in here. And what's good about this, whether you have a winning trade or a losing trade, it's always great to go back and basically look at that trade, see what you could have done better. Even if it's a winning trade, you might have left money on the table, you might have been able to find a better entry or exit points on the chart. There might have been a better strategy that would have given you better signals. You know, so it's always great to go back and look at and overview your trades at the end of each trade when you close them out. So this is a great thing. Also, what I'm going to do, anyone that wants copies of this, I'll be glad to photocopy some and send you some either in the mail, or I'll send you some through an email, and you can print them out and have them. Like I said, all you have to do is print that out, and you could copy, you know, 100, 200 of these and have them on a daily basis when you're making your trades. Whether you're day trading, swing trading, long-term investing, it's always good to have a logbook and to go over your trades after the fact. And even during the trade, it's good to always, you know, keep on track of your trades and keep your targets in mind, your stops in mind. And always use stop-loss orders. I can't stress that enough. And then our next class, I want to go more into the details of spreads. By then I should have my whiteboard and I could do a live interaction presentation with you guys. But one of these classes I want to do on trading plans. I told you guys about this. I read a lot of books. I try to read at least 3 to 5 books a week. And this is one of the books that I've had like 7 copies of, and traders I've met over the years, I've given them these copies because I see they're struggling with trading plans, strategies, methods, and this book really goes over that, and it goes over stop-loss orders, how to choose stops, and how to find good entry and exit points, and just how to manage your trades and build a great trading plan. So one of these classes, I'm going to make a great presentation on trading plans, how to create them. I actually have a YouTube live video where I went over, let me see if I could find it here. I went over creating a trading plan outline, all right? And that was basically, I don't know where that presentation went. It's somewhere here, but, you know, I just went over, I want to find that because that was a great presentation that I had, but I don't know where it is here, guys, but any questions you guys have? I'm going to, now that I have this new headquarters, new office here, I'm going to be doing some live, since I have this stand for the cell phone. Like I said, I have a huge 6-monitor array coming from Falcon Trading Computers. I'll be doing a video on that once I get it, and basically doing a review on it, what I think of it, and also if you guys want to purchase one, the CEO of Falcon Trading gave me a special promo code to give you guys. That promo code is 34747, just my zip code. For you guys to use. I think it gives you 15% off your purchase. My computer that I personally got, it was worth over $5,000. He gave me a discount on it since I have a trading exchange, a subscription-based service. Any questions now that you guys want to go over? First off, let me say this before questions start rolling in. I'm going to start doing classes on a weekly basis. I'm going to do a few more that are open to the public like this. And then I'm going to focus on the classes for my members of the Santarelli Exchange. So if you guys want to join the Santarelli Exchange, you can go to www.thesantarelliexchange.com. It's also linked below in this YouTube video. And like I said, I'm going to be doing weekly presentations, some type of class, course, video. And then also I'm going to start doing daily over-the-shoulder trading, and showing some day trades, showing some chart setups, some patterns. I made a great video on breakout stocks. I have 3 patterns that I follow for high probability trades, and those patterns are breakout stocks. They're great patterns, and like I said, I made a video on finding breakout stocks, how to identify them. Second one is hook patterns. Hook pattern setups are high probability trades as well. And then our momentum stocks, ones that have momentum behind it and keep moving higher. And I don't know if someone was just knocking at my door or what. Someone there? So anyway, guys, so if you guys have any questions now, feel free to ask them and I will answer. I'm looking here now, so let me see if I could I click this? Can we sell spread whenever we want? Alright, good question. A spread like this, like we were going over, a spread that you got for 80 cents a contract, let's say, like I said in that example, we bought the 977.50, 980 call spread. The stock's only at 961.35 now. And we had, in that example, the October 20th expiration. So if the stock gets higher, closer to those strikes, that 80 cents that you paid for it is going to be closer to $1.20, $1.25. So once the stock gets up there, yes, you can sell spread anytime you want. You don't have to wait until expiration, but you're not going to see your max value until expiration day, when the stock is, you know, like I said, closer to expiration and closer to those strike prices. So yes, you could sell it anytime you want. You don't have to hold it until expiration. Now, if the stock, like I said in that example, our max gain is with Amazon at 980 or higher. Now, let's say, for example, this week Amazon got to $1,000 a share. Well, that spread, you're going to be able to sell for $1.70, $2 a contract, you know, somewhere around there. And, you know, pretty close to max value. Your max gain on that, or the max it could be worth, I should say, is $2.50. So if you bought it for 80 cents and the stock goes to $1,000 next week, you know, you could easily sell that for anywhere between $1.70 to $2 a contract. And if it's next week and it's at $1,000, you should be able to get $2.20, $2.30, maybe even $2.40 a contract. The higher it goes above those strikes, the closer you're going to get to receiving that max value, that $2.50, before expiration date comes. Any other questions, guys? Let me see here. Please, guys, if you have any questions, please ask now. And like I said, I have a lot of stuff ordered, so we'll be doing more detailed courses, classes, videos. I'm waiting for stuff to come. I ordered some stuff on Amazon, some other sites, so once they come, we'll be doing many more. Selecting delta and DT. Alright, so delta for spreads. Let me see what. There's so many. Turn the camera where? Where would you like me to turn the camera to? Then I'll answer the question about the delta. No, Aspen. I think even this spread that I just went over on Amazon, it won't let me do that on YouTube. I tried that and it tells me orientation is locked, rotate device back. So it won't let me do that. So yeah, guys, back to this example here. Where did I put my laser pointer? So back to this example right here where we have the Amazon. I don't know if you guys could see that laser pointer there, but back here to this example, let me go change this quick. Get this out of the way. So back in this example here, yeah, there is about a 4-second lag, 5-second lag in YouTube. Yeah, there must be a way to rotate the camera, but like I said, when I rotate it, it tells me orientation is off to rotate it back to the other position. So guys, what was I going to say here? Oh yeah, I do think that this is a great trade to make, especially if we're going with the October 20th expiration. If you're looking at the Amazon chart right now, let me see. Yes, I'll get over Delta with you in a second here. Back to this though, the October 20th expiration. Amazon is coming out with earnings on October 26th. That's when their expected Q3 earnings are. So I do think that Amazon, since it's been beaten down so badly, I do believe that it's going to start to ride higher into earnings. And I do think, if you're looking at the chart now actually, it looks like it has some momentum and it does have a confirmation of a breakout. If you watch my videos, a confirmation of a breakout pattern is when it crosses the 10-day, 20-day, and sometimes the 50-day SMA, simple moving averages. So it just started doing that now, and it is in breakout mode. At least it's in momentum mode. So I do think Amazon's going to test getting back to $1,000 a share by October 20th, or at least before the day it reports earnings. I definitely think we'll see Amazon back to $1,000 before they report the Q3 earnings. So a spread like this that can make you a 212% gain, that is a great spread to get. And let me go over here. Let me look at my computer quick. You could do further out of the money spread. For example, if you went with the, let's see here, the 987.50, 990 call spread, that only costs 70 cents a contract. Where's that other one? That's not right here. Wait, let me see. I had it wrong here, guys. It is, let me see. So if you do the 992.50, 995 call spread, it's only going to cost you 53 cents a contract. So 2.5, divide that by 0.53. So if you did that, you're going to make a 372% gain. 372% max net gain if you bought the $992.50, $995 call spread, and Amazon gets to that $1,000 a share by October 20th monthly expiration. All right, your thoughts on laddering? I think it all depends on your expiration date, how much time, and the momentum behind the stock. If I see, for example, I actually bought a call spread on Amazon. I posted for my members of the Santarelli Exchange. We got into a call spread for Amazon. I'm not sure if it was for, let me see here, what expo it was for. Hold on one second, guys. Let me see what we got here, the trade we just got. Alright, so on Friday we just made a trade on Amazon for, hold on, it's coming up here. We got the 962.50, 965 call spread for October 20th. This is one of those trades that are very high probability. It's basically an at-the-money call spread, and we paid $1.28 a contract. So 2.5, divide that by 1.28. So our max gain on this trade is a 95.31% gain. And like I said, we only need Amazon to go $3.65 higher for that max gain, which, as you see, it was up $5 on Friday alone. So if it has another move like it had on Friday, anywhere between now until October 20th, we're going to have a 95.31% gain on the trade we made for Santarelli Exchange subscribers. So it's all about based on, like this trade, for example, I said costed $1.28 contract. If you went and got this trade, I do think that you could, scale into that trade. If you want to buy 5 contracts, now like I said, it's only $80 a contract. So a single contract's only going to cost you $80. If you want to get 5 contracts now, it'll cost you $400. That's fine. And then if you want to, as you see the stock continue to climb, buy more contracts, add to it, scale into it, that's also fine as well. But you want to take advantage of these lower premiums before the stock really starts to take off. And to the guy asking about the delta, if you're buying calls, straight out calls, then delta, thetas, they're important. But as far as spreads go, it depends if you're doing like an in the money, at the money, or out of the money spread. So if you're doing an at the money spread, you really, deltas and thetas, they really don't matter. A tiny bit, but they really have no influence. It's just based on that stock. With this spread, your main concern is the stock being above 977.50 in that example right here. So as long as the stock's above your break even, which is 978.30 in that example, then you start making profits. But your deltas, your thetas, in a spread really don't matter. Whereas if you have a call, you have a put, then yes, you have to look at your delta, your thetas, your gammas, and all that. But as far as Greeks go with spreads, it really doesn't matter. You're just looking at that stock to be at a certain price by a certain date. Is there any other questions, guys? There any other questions I could go over? Thanks, Mike. You've been a great member of the Santarelli Exchange for a while. You've been doing great with our service. So glad to have you. Brian, the TC2000 platform, it's amazing. I love how, guys, the questions are coming in so quick there. So when you see someone ask a question, wait a minute until I answer their question, then you can answer yours. The TC2000 trading platform, I think it has a lot of potential. It's something that I just started using 2-3 days ago. But as far as what it has to offer, I think it's great. You know, you could draw a trend line on the TC2000. You could draw a trend line and then have it alert you once the stock breaks through that trend line. Either breaks up or breaks down that trend line. You could have it send you an alert. And you could have it send you alerts based on any type of setup that you make. Any type of trend lines you draw or anything you want it to alert you on, it basically will. And you know, the TC2000 platform, it's easy to understand. Like, for example, you open up the TD Ameritrade's, the Thinkorswim platform. I use E-Trade Pro. I've been using that for nearly a decade. And you know, it took me a while to get used to E-Trade Pro, but now I'm fluent with it and fully aware of all of its functions and features. But Thinkorswim, you open that up, you're just bombarded by so much. Yes, it is, Brian. It's very confusing because you're bombarded with so much information. You know, that doesn't mean it's a bad platform. It's a great trading platform. It's just going to take you a while to get used to all those features and all those indicators and types of charts and everything you could do with it. So, you know, the TC2000, it's simple, it's easy, and you can do a lot with it. So I don't have a brokerage account with TC2000, but I definitely like using their charts, their studies, and like I said, for alerts, it's great. I am thinking about purchasing it though, so if I do, I'll let you guys know how I like it and some tips and strategies that I use on it. I will do that, Brian. Any other questions, guys? Also, I'm going to be doing, I might even do it tonight, I'm going to do a video on some oscillators, some indicators, oscillators like the RSI, Relative Strength Index, and also the MACD, the Moving Average Convergence Divergence oscillator. I want to go over those two strategies and then probably Bollinger Bands and moving averages. So those four things I'm going to be going over. I might do it tonight depending on how tired I am once I get some work done here for tomorrow. But that's another video that'll be posted here for you guys and you could check out. Any other questions? How did you guys like this video, honestly, compared to my normal YouTube videos where I'm doing a screen sharing session? Do you guys like the screen sharing better? Or how we interact like this and do a live presentation? Guys, whatever questions you just asked, please ask them again. I can't see. Let me see. Oh, wait, here. I could see them now. MC, how to make money using IV, implied volatility. Yeah, we can make a video on that. You know, this video is already 50 minutes long, but you know, I want to have videos sectioned off so people could reference them. You know, like IV, implied volatility video. I'll make one like that. IV is something I use on a daily basis. I actually go to this website called optionslam.com, and it tells you the weekly IV, the implied move for the week, for the month, its earnings date, and it's really great using the IV when you're looking for trading strategies and what to use. For example, going back to a call versus a spread. You know, if a stock has an implied move of 2%, you know, or for example, 1% for the week, you know, that's something you don't want to go with the call for, especially if it's not a blue chip solid stock like Microsoft or Bank of America or ExxonMobil, who has low extrinsic values. You know, if the extrinsic values are high in the options premium, then you need a larger stock price move to make some money. So ones with lower extrinsic value, you could have a smaller move in the stock price and make nice gains. But for example, going back to that situation there, if you're seeing that a stock has an implied move of 1% for the week, and you do feel that it's going to go higher, but it's only going to have that 1% move, then you're best using the spread strategy. You know, like I said, you could do an at-the-money spread and still make nearly or over 100% gain, and you only need the stock to move 1/4%. You know, that's pretty amazing when you think about it, that a stock can only move 1/4% and you can make nearly 100% return. So, you know, you really have to keep that in mind when you're trying to figure out what type of strategy you want to use compared to other ones, like a call versus a spread, or a straddle, a strangle, a butterfly, and things like that. Let me see the questions here. What about time frames? What's ABDO? Time frames, basically what I do when I'm looking at a stock and what expiration to get, I look at the stock chart, I look at what the stock has done for the time period that I'm looking to trade. For example, if I'm looking to get into a weekly spread or a weekly call, I look and see what the stock has done the past week. And, you know, I usually don't think that the stock's going to move higher than it did the trading range of the past week. So I'll look to make a trade within the trading range that it had throughout the past week. You know, if I'm looking at a 1 month trade expiration day, you know, I'll look and see what the stock did the past month. I'll look at support and resistance levels. I'll look at, you know, the trading ranges throughout that past month and decide where the stock could go from there. So you really have to look at support and resistance levels and the trading ranges the stock has had for the time frames you're looking to trade. Aspen, Facebook, that's a great question. I do think Facebook's going to run higher into earnings. I'm not sure exactly what day they report, but I do think we're going to see Facebook continually to run higher before it starts, before it reports its Q3 earnings. So what's the stock at now? $170, $171 a share. I do think we're going to see that close to $180 a share before Facebook reports its Q3 earnings. So, you know, if you're looking at the charts, these charts, especially tech sector, it's just starting to break out. It's got beaten down so bad over the past month or two, and we're just starting now to see a bounce. And I'm seeing some hook patterns that I like, some breakout chart patterns, and like I said, momentum patterns, which are my 3 patterns that I love to trade for high probability trades that make 200, 300, 400% gains. So those are important for me to watch and follow. Yes, Greg, even with that, Facebook is a solid company, solid stock. You know, it's not going to have any issues. I recall a year ago you mentioned the stock, right? Yes, Brian. Sometimes, you know, the stock has a big move based on implied volatility. You know, if they see IV is picking up, then the extrinsic value is going to increase and cause that premium to go up for that option. I like Microsoft. I think they're going to do well on earnings. I haven't looked at the pattern yet, the chart, I mean, so I can't really give you any detailed information. I haven't looked at the chart for Microsoft. But, let me see what else we got here. Aspen, banks. I don't know if you're a Santorelli Exchange member or not, but if you go to the SantorelliExchange.com, even if you're a non-member, you have access to market news. If you click on that tab, I actually just made a post on there about big banks. I think banks, with the Fed raising rates, think about this. The banks are sitting on piles of cash. As the Fed raises interest rates, the banks are going to make a huge interest on that piles of cash just by the Fed's raising interest rates. So these banks are going to make huge profits for not even having to do anything. They don't even have to lift a finger, and these banks are going to make massive profits just based on the Fed raising interest rates. So I think personally, if you want to get leaps for Bank of America, JP Morgan, Morgan Stanley, or any of the other banks, AIG is another one I like, I think calls for, you know, I would go with at least February 2018 or further out, even January 2019. If you get some calls and have the patience to sit on those, I think you can easily see 400, 500, 600% returns. And, You know, we're actually, in the Santarelli Exchange, we have something called the $1 Million Trade Challenge, and how that works is we pick stocks that have high probability, high chance of success, that are going to make large returns, and bank, we did one so far, that was on AIG, that made a 72% return, I think. That was our first $1 Million Trade Challenge pick, and now the second one, again, is going to be on a bank. I'm thinking about Bank of America or JP Morgan. I was looking at the February 2018 Expo, or even the January 2019 Expo. But banks are a great sector to get into now. I think it's easy money, easy profits, and easy trades to make off the banks now with the Feds raising rates. So banks are definitely something you want to keep an eye on. Yes, I do have a philosophy on the spread strikes. Me personally, if I look at a stock like Amazon and I think that it's going to go to $1,000 a share by October 20th, I'll do an out-of-the-money spread. I'll do something that still gives me buffer room in case it doesn't, if it struggles with that $1,000 area. You know, I might go with the 987.50, 990 call spread. So I still have 10 points away from the $1,000 a share, and going that far out of the money for the spread, I'll still make like a 300-400% gain, and that's my philosophy. If I think a stock's not going to have that big of a move, then I'll do an at the money spread. You know, as far as how wide the spread goes, there's no need to, you know, like for example, Amazon, it starts off with $2.50 wide spreads. I wouldn't go with anything more than that. That's silly. You know, you want to go where you think the stock is going to be at by expiration date. Give yourself a little room, though, in case it doesn't get there or in case it struggles. You know, so like I said, if you think Amazon's going to go to $9.90 a share by October 20th, then you might want to get the $977.50, $980, or the $982.50, $985 call spread. You know, give yourself a little wiggle room in case it struggles with that area. But, you know, there's no need to get the 970, 990 call spread. I think that's ridiculous. There's no need for that. If you think the stock's going to get all the way up to 990, then do a spread that's closer up there. You know, it's no point in making a wider spread, in my opinion. Thank you, Aspen. Thank you. Alright guys, so this is about an hour long here. I'm going to cut this now. I want to keep the videos under an hour long because then they get boring and people don't like to watch them. Cryptocurrencies, I do think cryptocurrencies are a good investment, but you have to be aware there's no regulation on them, and there's a lot of scam artists out there that are trying to sell things that they can't sell, or say they have Bitcoin and they really don't, you know, or anything like that. You know, you have to watch, since there's no regulation on it, you really have to watch what you're buying and who you're buying from. You know, you could really get yourself into some deep trouble there if you're buying something from someone or a website that's not well known. You know, you have to do your due diligence and really, you know, see who's the real deal out there or not. Yes, Brian, you know, like I said, presentations are going to get better, especially once I get the whiteboard. You know, this was a little sloppy. I like the white cardboard thing here, but once I get the whiteboard, then I like doing live interacting videos. And like I said too, when the trading day comes, once I get my rig, I'm going to do over-the-shoulder trading. I could put this right here, and I could have you guys watch with me as I trade. And, you know, like I said, I'll have the big rig here, so you'll see a bigger screen and everything. And I could do some analysis, show you guys what I'm trading, and do things like that. And basically show you guys the ins and outs of trading. Yes, I am going to be setting up a weekend trading workshop. It's just I have so much going on now. I just I just got this commercial lease on this big building here, so I'm getting everything in my office prepared and all that stuff. Sure, if you want to send me a whiteboard, feel free. The address is 7799 Stiles Boulevard, Kissimmee, Florida 34747. And make an attention to Santarelli Trading Exchange. That would be nice. I'd be grateful. Alright guys, so like I said, we're at an hour here, so I'm going to get going. I'm going to focus on some research now for tomorrow's markets. And Brian, I never sleep basically. I sleep every like 2 days. I am exhausted. Today I went to sleep at 2:30 and I woke up at 5:15. So I got like 2.5 hours of sleep. So gonna do a little bit of research tonight and then get home, get some well-needed sleep, and be up and ready to trade tomorrow. Alright guys, have a great night. It was great having you. Please comment below. Do you guys like presentations like this where we interact, do one-on-one? Or do you like when I have the regular YouTube screen sharing videos? Let me know that right now, please, in the comments. Do you like the screen sharing videos better, those types of presentations, or the interactive ones? Anyone else want to chime in? Yeah, once my wife's coming home from Brazil tomorrow, her flight leaves, she'll be here Tuesday morning. So we have a couple cameras that are quite expensive cameras, and she's going to help me set them up so I can do some videos. They have Wi-Fi on them too, so I think I should be able to do YouTube live videos and things like that. So we'll see when she gets here. She's the one that knows a lot about. The address is 7799 Stiles, S-T-Y-L-E-S, Boulevard, B-L-V-D, Kissimmee, Florida 34747. Alright guys, have a great night. I'm going to go get some research done, some work for tomorrow, and then get home and get some sleep. Have a nice night. It was great having you. And if you'd like to join, you could go to www.thesantarelliexchange.com and join, and we have the best option alert service out there, and education. We have a lot of great traders in there and a couple of TSE employees that'll be there to help you out. Yes, I agree. We got to control it. It gets, it turns a 15-minute presentation into an hour. So have a nice night, guys, and take care.